The numbers on the national debt clock in Manhattan do not merely tick, they race, blurring into a digital haze of red that few passers-by stop to comprehend. Every single second, thousands of dollars are added to a national burden that has long since defied human scale. For decades, the American economy has operated under the comforting, heavy blanket of an illusion that deficits do not truly matter, and that the owner of the world's reserve currency is somehow immune to the laws of financial gravity. But in the quiet, marble corridors of the Federal Reserve and the frantic, glowing terminals of Wall Street, a chilling narrative is taking hold. We are no longer approaching the precipice. We are standing directly on the edge of a fiscal cliff, staring down into a chasm of compounding interest and unpayable obligations. It is a quiet crisis, one that does not initially announce itself with crashing stock markets or shuttered banks, but with the subtle, creeping rise of yield curves and the widening spread of credit default swaps. The bedrock of the global financial system, the U.S. Treasury bond, is showing hairline fractures. This is not a matter of partisan politics or temporary budget squabbles. It is a matter of brutal, unforgiving arithmetic. When the cost of servicing the past consumes the resources required for the future, the system inevitably creates its own shockwave. The air is thin here at the edge. The markets remain eerily calm, buoyed by decades of liquidity injections and sheer habit. But history whispers a warning to those willing to listen. The storm is not coming. It is already here, disguised as stability.
The warning signs are already flashing, though they are often buried beneath the headlines of daily stock market fluctuations. To the trained economist, the dashboard of the American economy is lighting up with red indicators. The most immediate alarm is sounding in the commercial real estate sector, a trillion-dollar asset class now trembling under the weight of higher interest rates and shifting work habits. As refinancing walls approach, regional banks, the very lifeblood of small business lending, find themselves holding balance sheets laden with depreciating assets. We see liquidity drying up in the repo markets, the plumbing of the financial system, where cash is exchanged for collateral overnight. When this grease turns to sand, the gears of the economy seize. Perhaps most disturbing is the movement in credit default swaps on U.S. sovereign debt. The cost to insure against an American default, once a negligible fraction, has risen to levels that suggest institutional investors are no longer treating the unthinkable as impossible. The yield curve remains stubbornly inverted, a historically reliable harbinger of recession, signaling that the market expects short-term pain to eclipse long-term growth. These are not isolated glitches, they are systemic tremors indicating that the foundation is struggling to support the superstructure of debt we have built upon it. Understanding the mechanics of a fiscal shock requires looking past the total debt figure and focusing on the serviceability of that debt. The trap closes not when you owe too much, but when you must borrow simply to pay the interest on what you already owe. This is the Minsky moment, a tipping point where stability breeds instability. As the Federal Reserve raised rates to combat inflation, the interest expense on the national debt skyrocketed, now rivaling the entire defense budget. This creates a vicious feedback loop known as fiscal dominance. The government must issue more treasuries to cover these interest payments, but the flood of new supply overwhelms demand, forcing yields higher and further increasing the cost of borrowing. It is a mathematical chokehold. In this environment, economic shocks do not dissipate, they amplify. A sudden spike in oil prices or a disruption in global supply chains does not just cause temporary inflation, it exposes the fragility of a treasury that has no fiscal buffer left. The mechanism of collapse is rarely a singular event, but a cascading series of liquidity failures, where the central bank is forced to choose between saving the currency or saving the bond market, a choice where, inevitably,
the average citizen loses. We often succumb to the dangerous arrogance of American exceptionalism, believing that the laws of economics apply differently to the United States. Yet a study of global financial history reveals a hauntingly consistent pattern. Whether we look at the Asian financial crisis of 1997, the collapse of the Argentine peso, or the sovereign debt crisis of Greece, the anatomy of the fall is identical. In Venezuela and Turkey, we witnessed how rapidly a currency can debase when fiscal discipline is abandoned for populist spending. In Greece, we saw the social devastation of austerity measures imposed when the credit card finally maxed out. While the US dollar's status as the world reserve currency provides a longer runway, it does not grant the plane the ability to fly without fuel. The exorbitant privilege of printing the money the world uses for trade has allowed the US to run deficits that would bankrupt any other nation. However, as the BRICS nations and other global powers begin to diversify away from the dollar, diversifying their reserves into gold and other currencies, that privilege is eroding. We are effectively importing the characteristics of an emerging market economy: high inflation volatility, massive twin deficits, and political polarization, but layered onto the massive scale of a developed G7 nation. The impact of this fiscal precipice on the domestic economy is not an abrupt explosion, but a slow, agonizing suffocation of growth. As government borrowing crowds out private investment, we enter a period of secular stagnation. Capital that should fund innovation, factory upgrades, and small business expansion is instead vacuumed up by the Treasury to service past consumption. For the average American, this manifests as a cost of living crisis that never truly ends. We see the erosion of the middle class accelerated by persistent, sticky inflation, a feature, not a bug, of a system trying to inflate away its debt burden. The housing market freezes. Homeowners are locked into low rates, while new buyers are priced out by mortgage rates that reflect the sovereign risk premium. We face a stagflationary environment, reminiscent of the 1970s, but with significantly higher leverage ratios. The real value of wages declines even if nominal pay rises, creating a phantom growth that feels like recession. Infrastructure projects stall as federal funding becomes constrained by debt service, leading to a visible decay in public services. The American dream of upward mobility faces its stiffest headwind as the economy pivots from wealth creation to debt management. Confronted with this mathematical inevitability, the response from the Federal Reserve and the government will likely follow a predictable, albeit desperate, playbook. History suggests that when a sovereign nation cannot pay its bills in real terms, it chooses inflation over hard default. We can expect the central bank to eventually abandon its inflation targets, implicitly raising the acceptable ceiling to 3% or 4% to lubricate the debt. We may see the implementation of yield curve control, a strategy where the Fed commits to buying unlimited amounts of bonds to cap interest rates, effectively printing money to fund the deficit directly. This prevents immediate bankruptcy, but sacrifices the dollar's purchasing power. Furthermore, policymakers may turn to financial repression, regulations forcing pension funds and banks to hold depreciating government paper. In the background, the push for central bank digital currencies accelerates, offering a tool for more granular control over liquidity and negative interest rates. These measures are presented as stabilization efforts, technical fixes to complex problems, but they fundamentally represent a transfer of wealth from savers and wage earners to the indebted state. In an era defined by financial repression and inevitable currency devaluation, the traditional strategies of the past 40 years are no longer sufficient sanctuaries. The individual must pivot from a mindset of passive accumulation to one of active preservation. The first line of defense is the ruthless elimination of variable rate debt, which acts as a heavy anchor in a rising interest rate environment. Beyond the balance sheet, one must look toward hard assets, tangible stores of value that cannot be diluted by a central bank's keystrokes. This includes residential real estate with fixed-rate debt, precious metals like gold and silver, and commodities. These assets have historically served as the only reliable hedges against the secular debasement of fiat currency. Furthermore, human capital becomes the ultimate non-confiscatable asset. Acquiring skills that are resilient to recession and decoupled from financial sector volatility is paramount. Diversification must extend beyond asset classes to include jurisdictional awareness, mitigating the risk of being solely tethered to the U.S. fiscal trajectory. It is not about hoarding for the apocalypse, but about financial agility. Understanding that cash is a melting ice cube means keeping only what is necessary for short-term liquidity, while deploying capital into vehicles that track inflation rather than getting crushed by it. The rules of the game have changed, and playing by the old rulebook is a guaranteed path to poverty. The fiscal cliff is not merely a pessimistic prediction, it is a mathematical horizon we are rapidly approaching. The numbers, cold and unyielding, tell a story of a nation that has borrowed from a future it can no longer afford to subsidize. We are witnessing the twilight of an economic cycle that spanned decades, marking a painful transition from the age of easy money to the age of consequences. The United States remains a powerhouse of innovation and resilience, but these virtues will be tested as never before in the coming years. The solution will not come from a magic wand waved in Washington, but from a collective reckoning with reality, a necessary return to sound money, fiscal discipline, and the forgotten truth that wealth must be produced before it can be consumed. As the sun sets on the era of unrestricted deficits, we are left with a stark choice: to voluntarily restructure our obligations and endure the temporary pain of correction, or to drive blindly off the edge and let history dictate the terms of the crash. The debt trap has snapped shut. The question is no longer how to escape it unscathed, but how to endure what comes next with our liberty and prosperity intact. The clock continues to tick, louder now in the silence of our inaction. There remains, however, a singular variable that defies standard economic modeling: the exponential curve of technological deflation. Optimists argue that we are on the cusp of an artificial intelligence revolution that could unleash a productivity boom large enough to outgrow the debt burden. The theory posits that if AI can radically lower the cost of goods and services, effectively demonetizing energy, labor, and intelligence, the resulting deflationary pressure could counterbalance the inflationary force of money printing. In this scenario, the United States attempts to innovate its way out of insolvency. We see capital flooding into data centers and semiconductor foundries, betting that the GDP of the future will be so vastly larger than today's that current debt levels become trivial. Yet, this is a race against time. The compounding mathematics of interest payments are linear and relentless, while technological breakthroughs are lumpy and unpredictable. If the productivity boom arrives too late, or if its benefits are captured by a narrow few rather than the broad tax base, the fiscal math remains unsolved. We are witnessing a collision between two massive forces: the inflationary need of the state to debase currency to service debt, and the deflationary force of technology trying to lower prices. The victor of this clash will define the standard of living for the next generation. Ultimately, the narrative shifts from prediction to the cold, hard reality of the data. For the vigilant, metrics like the term premium on long-term treasuries and the bid-to-cover ratios at auctions are no longer obscure academic figures, but the vital signs of a system in distress. Yet the most fragile component is not the bond market, but the invisible thread of trust that binds the citizen to the state. Money is a social contract. When a government knowingly debases it to fund political expediency, it defaults on its promise to the people. We are witnessing the twilight of an illusion. The resolution requires a painful but necessary return to solvency, a restructuring of not just debt, but of expectations. As the credits prepare to roll, consider this. Since this program began 30 minutes ago, the national debt has swelled by another $50 million. We leave you with the image of a newborn in a hospital ward, a citizen who has just inherited a six-figure share of public obligations they never signed for. The fiscal cliff is not a future event. It is the ground beneath our feet crumbling. The debt trap has snapped shut, and the era of the free lunch is over. The clock continues to tick, louder now in the silence of our inaction.
Panic is not a strategy, but preparation is. The macroeconomic landscape is shifting beneath our feet, and the mainstream narratives often lag behind the mathematical reality. To help you navigate this transition, we have compiled a detailed resource list, including the specific charts on Treasury yields, historical data on hard asset performance during stagflation, and the primary sources used in this documentary, linked below. Do not take our word for it. Verify the numbers yourself. If you found value in this analysis and believe that financial literacy is a defense against fiscal irresponsibility, please share this documentary to help wake others from the slumber of normalcy bias. The warning signs are flashing. Whether you choose to act on them is the single most important financial decision you will make this decade. Stay vigilant.